Well, I think the market is a little bit ahead of itself. As of last Friday, 94% of the near 150 sub-industries in the S&P 1500 were trading above their 50-day moving average, and 97% of them were above their 200-day moving average. Both of those measures are well above levels of extreme that usually indicate we're going to probably go through some sort of digestion phase over the next several weeks. I think, yes, the market is discounting the end of the controversy surrounding the election, the potential for a vaccine to be introduced early in 2021, and then distributed by maybe the end of the second quarter of 2021. And that should have beneficial implications toward economic growth and earnings increases, but we're still a good 6 months away. There has been a lot of undulation with the groups that were beaten down the most during the initial COVID sell-off. So airlines, cruise ships, restaurants, hotels, etc., those that require a gathering of a multiple of people. And so when there's favorable news surrounding COVID vaccine, then they're the ones that are going to benefit, because if they have not gone out of business yet, they probably won't go out of business. And a vaccine will give reasons for investors to feel optimistic that these companies' earnings can start to turn around once their theme parks, cruise ships, etc., start taking in new passengers. So right now, I think it's more of a shorter-term trading event with an eye toward the reopening of the economy 6 months or so from now. I think that for the growth areas, in general, they're probably starting to give way to the value side of the equation. When you look to the S&P Value Index versus the 500, S&P Small Cap versus the 500, Developed International, the EFA, as well as the emerging markets, all of them have bounced off of their bottoms and are now trading above their 50-day moving average, with emerging markets above the 200-day moving average. So I would say that there does appear to be a meaningful rotation that is taking place. Does that mean you should sell all of your growth stocks? No. I think that there are still some of the large behemoth tech companies, as well as consumer discretionary and communication service companies, that still warrant purchase. In terms of technology areas like Microsoft, we still think represent a good opportunity. In terms of data processing and financial, that would be Visa. We still have a favorable impression on. Amazon, we have a buy ranking, as well as on Alphabet. So these are companies that if there is weakness, you would probably want to buy for the longer term. Ditto for Apple. But other companies, let's say exercise machinery, etc., my feeling is, where is the moat to that business? Where is the barrier to entry or competition? Those companies that sell you the ingredients in order to make dinner. Your local grocery store can do that for you. There's no barrier to entry, in my opinion. And when we come out of this COVID situation, ask your friends to see how many of these expensive exercise equipments are now being used as drying racks in the laundry room, or whether they're actually being used on a daily basis. So not all of the growth stocks should be sold, but I think some really don't represent the opportunities that others do. Well, we are optimistic for the market in the year ahead. We recently established a 2021 target of 4,080 on the S&P 500, which represented about a 15+% price appreciation from the closing value of when we set it. That said, however, that would imply about 3,600 for the year-end 2020 for the S&P 500. And right now, we're already trading above that level. So, as I said before, I believe the market has gotten ahead of itself. I do think that we're likely to see some sort of digestion of near-term gains, but I think longer-term, the bull market is intact and the trajectory will be higher.